Everyone, PubMatic reported earnings earlier this week and the stock took a hit. We've gotten lots of requests to review the company's fourth quarter earnings results, so that's what we're going to do next. And joining me this week, Brian Stoffel is back in action. He was trapped in vacation for nearly a month, but he is back joining me on the channel. So thrilled to have him back.
Excited
Brian, yes,
to be back. Yes.
Very cool to have you here. Don't know if you paid attention to the markets at all while you were gone, but some stuff happened.
Not honestly, so for people who don't know, my family and I, we live in a container home on a Costa Rican coffee farm, and we don't get internet in our home. And we ended up having to quarantine because we got COVID. Everyone's fine, but we got COVID right before we were about to leave. And so that extended it for over a week. And we couldn't leave the container, and then like some paths through the coffee fields around it. But that was it. Like that was our entire world for about 7 days.
People are asking me, did you and Brian break up? What happened to him? And I'm like, nope, he's just on vacation. So there you go.
COVID, proof. On vacation.
But with that, let's get into it, Brian, shall we?
Yes. And I'm curious about this, Brian, just for what it's worth. I'll put out there that I got to have internet for short stints. And so I did see that it went down a ton earlier in the week, but that's like pretty much it. I know about that. And I know that there's something happening between Russia and the Ukraine. And like, that's the extent of my world knowledge.
There you go. Well, let's figure out what happened here, because to your point, the stock did go down, but the headline numbers, so 29 cents in earnings expected, 48 delivered. That sounds good.
That's pretty good.
That sounds good. Barely beat on the top line there. So that's what happened there. But if you're looking, hey, the headline numbers, why did this stock go down? I don't know.
I'm really curious to see what free cash flow did now too.
Yeah. Okay, so oops, that's zoomed in a little bit too much. Wrong button. So okay, so there's the they have a presentation. There's the press release. Does this company give guidance? Do you know?
I believe so.
Okay, so let's try and find what that could be. Quarterly results, and we'll go to Q3 first, and we'll just kind of dig through that to see if they have that. So this is the third quarter results, so last year. Okay, so there we go. So for the fourth quarter, 74 to 76.
And I think it was 75.5, I think.
I think that's what it roughly was. So 75.6. So yep,
okay.
within guidance range. So let's see what happens.
That's a pretty tight range too.
And now you know why Brian Stoffel likes this company so much. The first slide of their quarterly illustration is our mission. Fuels the endless potential of internet content creators. Okay, so revenue is up 34%. GAAP net income margin of 37%. Man, that is so impressive. GAAP. Not that big of a difference between GAAP net income and adjusted EBITDA too. Okay, so for the full year, revenue is up 53% with a 25% GAAP income margin and a 42% net income margin. Okay, our total addressable market has expanded. Digital ad spend is currently $433 billion. Okay, good. Growing our market share. Estimated PubMatic market share is 3 to 4%, plus 1% year over year.
Now, just to put that in perspective, when your pie is growing and you go from 2.5 to 3.5%, that's a huge jump.
You're outgrowing the market. Okay, and as shown is their big time top line. Expanded usage via supply path optimization underscores increased value for buyers and SPO partners. SPO.
If anyone's watching and knows what SPO is, let us know.
Share of activity on our platform from SPO is 25%. Don't know that acronym off the top of my head.
We went through it. I remember going through that when we did this company, and now it's eluding me.
Connected TV revenue grew 6x, sixfold in the quarter. Okay, audience addressability innovation drives expansion use of platforms. So we now have first-party data with
that first-party data is important because that's something they have that no one else has.
New countries. Are these offices? Why are they listing cities? Okay. Retail media expands PubMatic addressable market. Retail media. So media and ad spend. Oh, okay. Reinvesting profits to accelerate growth. owned and operated infrastructure, engineering, and sales and customer support. So is
Oh,
this going to pull down their margins for the time being?
Yes, but that also might be what those offices were too. Like it might be what places, because now I'm remembering that Magnite, for instance, they are not vertically integrated in the same way that PubMatic is, which is a lot more cost up front, but then you enjoy the benefits later on.
And you get the scale benefits, and you own the infrastructure and everything like that.
And
but look at that growth.
And what's impressive, I just want to say too, what's impressive is they're putting that money in up front, right? But they're still profitable on a GAAP basis. And
Yes.
we'll look, and I think that they're generating good free cash flow too.
So, but look at the growth number. So 34% in the fourth quarter. That was down, but this is COVID headwind, COVID tailwind. So that's what that is there. But anyway, a very strong year. Look at that.
Let me ask you something. If you go back up, are you surprised by that fourth quarter 2019 figure? I mean, that's pretty slow.
Oh yeah,
it's interesting.
That was before COVID.
Yeah,
so they picked up. Their business accelerated substantially.
Yeah,
because of this. But they've been profitable. So this is a company with just profitability built into its ethos. 60,000 advertisers. Growth is strong. 41% growth in omnichannel. Okay, we saw all that. Growing revenue visibility and predictability. So 149% net dollar-based revenue retention rate.
That's just insane.
It's very, very high.
And that's comparing 2020. And I know they get a little bit of a benefit there from Q1 of 2021 because it's comparing pre-pandemic to post-pandemic, but still.
Very good there. Ad impressions up 96%, cost of revenue per 1 million impressions. So this is their scale.
So yes, let's talk about this. Oh, so that's their scale. Okay, sorry, I was reading that wrong. I was thinking impressions and cost, like a cost per click type thing, but that's not what it is.
Cost of revenue per 1 million, a cost of revenue. So what it costs them to deliver 1 million impressions has fallen by half in 2 years.
2 years.
And that's the benefit of their scale and their
owning the infrastructure,
in their platform,
the servers and everything.
Gross margin up to 74%. Is this adjusted? Oh no, this is quarterly, and 70 annual and quarterly, so 78%. So really strong gross margin, scale efficiencies, increased utilization, operating expenses. So the business is scaling. The biggest cost is sales and marketing usually. Yep, sales and marketing, technology and development, but it's the lean company. 30% increase in headcount, increased public expenses, scale efficiencies, GAAP and non-GAAP income. So $1 in GAAP net income. What's this stock trading at? Like 20?
Like 27?
25?
Let me check. I'll check real quick.
Yeah. So company's trading at 25 times earnings. On an adjusted basis, a little lower.
That's
for the full year.
So I've been gone for a month. Is that reasonable these days?
Yeah.
I don't know.
Yeah. Cash provided by operating activities. So this would be their free cash flow. This is not free cash flow, but this is the top line of their free cash flow. $89 million. So that number surged. Automations, offshore R&D, working capital. Okay, so guidance. So this is where they could get into trouble. So for the first quarter, revenue of, call it 54 million. So what does Wall Street expect? So if we go to the analysis tab, Wall Street was expecting right in the middle there. So, that's sort of at the low end. Where is it? There it is. And then for the full year, 282 to 286. Right in the middle there. So the guidance was, I would say, squarely in the middle. They're calling for 25% revenue growth for the full year. Adjusted EBITDA, roughly the same. CapEx of 30 to 33 million. So they're going to be spending big time. But anything huge here to note?
Just the stock-based compensation was pretty high for the year, but they also went public, so that's not too surprising.
And $14 million is not that high.
No, it's not.
When compared to
1.5 billion
revenue. Yeah, that is, I would not ding this company at all for stock-based compensation. It's profitable and everything like that. All right, let's take it at the call. Full PubM transcript. By the way, this is why I like to wait a day before I look at the earnings reports, because then you can get an easy transcript to read through. It's so much more efficient than listening to the conference calls. Listening to the conference calls is great if you want to get to know a company and the inflections of management.
Time suck.
It just takes so much longer. Okay, can you see that? Okay.
Yep, that looks great.
Even better. Okay. We have grown significantly. Record growth of 34%. Strong EBITDA margin of 51%. Over double the Rule of 40 benchmark for the 5th consecutive quarter. Wow.
That's not surprising given how profitable
unique
they
infrastructure, usage-based software model, grow our market share while delivering incredible growth and profitability. 53% organic growth. 25% adjusted EBITDA margin. The leverage in our model, end of the year with record $88.7 million in cash from operations, market share gains. Digital advertising market grew 31%, and they grew 34%. So slight uptick when compared to the market. So that might be a cause for potentially Wall Street doing shrug emoji, right?
Mm-hmm.
Digital advertising is not a pull forward.
Let's talk about what this means right here, because I think this is really important. Because what they're saying is so let's say Zoom or Netflix. Netflix is a great example. We use it for everything. A pull forward just means that people that you expected to sign up for Netflix in 2022 or 2023 or 2024, based on your best guess, they all of a sudden did it in 2020 because they were trapped at home. And they said, why not? I want to watch Orange is the New Black or whatever. With digital advertising, they're saying, no, it's not like people started digital advertising in 2020 and then they're all of a sudden going to stop. It's where we're going to probably most likely be by 2030 anyway. And this just sped it up. Right. Because the key is that it's usage based.
Right.
That's the key.
And that's one of the reasons why they have such an incredible dollar-based net revenue retention rate.
And one thing there's a couple of things I just want to throw in there from our comments. Because Gumi said SPO is supply path optimization, which basically means if you and I have our own website, then we want to place ads. That's how it works. It's a new product they've been working on. And then also, I think Sarkis points out that digital ad spend grew 54% versus the market's 31%. So they are capturing more.
Yes, thank you for that. That is an important point. I was looking at the Q4, not the full year number. You are correct. But they're saying banking is moving online, grocery delivery is moving online. All those things are moving online. That increases our opportunities. These changes have increased our addressable market opportunity considerably. Is committed to delivering the value to them. As an independent technology company, we provide a platform that connects disparate parts of the ecosystem with a robust audience. Our infrastructure-driven approach is delivering superior outcomes and cost efficiencies that both our customers and we can benefit from. The more value our platform delivers, the more our customers use our technology. This generates more high-margin revenue for us, which we continue to reinvest. We estimate our market share to be 2 to 3%. Now we're at 3 to 4%. A shift of 1% is quite significant.
Exactly. That's what I was saying earlier. It's huge.
We're aiming for 20% plus over the long term. Supply path optimization. There you go. SPO, omnichannel formats and channels, and global expansion are driving increased usage of our platform. We pioneered supply path optimization several years ago. Buyers are continuously looking for ways to optimize their spend through robust targeting, direct technology integrations, and workflows. Investments we made in these areas create a long-term strategic partner that aligns buyer success with our success. Okay. We grew our SPO partners by 44%. So they're really making big time. A quarter of our activity is now via SPO agreements, up from just 10% at the beginning of 2020. So this is a really successful program. It allows us to match buyers' needs and publisher inventory at scale, regardless of device. Okay. CTV and over the top has expanded our addressable market opportunity, although they launched just in Q3. Just launched that in Q3, and it's really taken off. The Trade Desk is noting the exact same thing, that CTV is like their highest growing category, connected TV. So streaming, exactly. We're growing. Identity Hub allows publishers to seamlessly manage their multitude of identity solutions. Yeah, we talked about that in our deep dive into them. They partner with LiveRamp and Identity Hub for first-party data. Audience Encore allows first-party data ownership to scale their audience across billions of daily ad impressions. Partnership helps. Yep. So this is basically, okay. Well, this is, let's read this. As the use of contextualized targeting increases, we are well positioned to support publishers and buyers' needs to package and monetize contextually targeted impressions, both in the open market and private. We started to see momentum build as third-party cookies are
I think that's supposed to be depreciating.
Yeah. And we believe this growth in these areas will accelerate. Existing customers are already starting to expand use of our platform through audience addressable solutions, and we're seeing these solutions attract new customers to PubMatic. It's worth noting that Google recently announcement of the depreciation of Android advertising ID in 2 years is expected to have minimal, if any, impact on our business.
And it's funny. Do you remember when we talked to the chief, I think, technology officer at SEMrush? He said more or less the same thing, that when these cookies disappear, it actually makes some of the things that they're trying to do more valuable because it's harder. That first party data that they have becomes more valuable.
Mm-hmm. Yeah, that first party data is definitely key. We know from prior experience that odd dollars shift to channels where buyers find success. Because we're omnichannel, we're able to fulfill ad buyers' needs in other channels such as TV. We saw this dynamic when Apple eliminated IDFA with no impact.
Who was it that we were reviewing? Oh, it was Facebook, and they talked about how it had an enormous impact.
$10 billion in sales. On there. Where new geographies, we entered South Korea and opened offices. So they opened 4 new offices. With China, we're focused on the 9 Chinese audience and inventory from Chinese app developers. We believe our international investments will develop into significant long-term growth opportunities. Huge market. Retail.
So wait, they said 100. They said 140 billion by 2024.
Yep.
So that's 28 billion that they're shooting for. If they were to, they won't reach by 2024. We should assume, but so 28 billion is what we're looking at. And what was their we don't know exactly what their ad spend is on the platform.
No, we don't. But they covered this in the slides that we covered.
Yeah,
basically, our addressable market is growing. We already work with several dozen e-commerce companies such as eBay and Gap to monetize impressions. E-commerce ad spending is a top 5 buyer vertical into vertical for us. Okay, retail is playing to our strengths. Okay, specialized cloud infrastructure. Innovation and efficiency are key differentiators that enable us to deliver customer value and expand platform usage. We tend to make substantial new investments based on where we see long-term potential, include machine learning and data processing, consisting with the evolving nature of our towards first-party data, okay, and towards supply path optimization. These are long-term investments that we believe will pay off in increased customer value and market share gains. We intend to improve efficiency across the company, which allowed for shift to software faster, increased passive rate. Yeah, we're making all these investments because it'll make us a stronger company. Our hiring plans calls for doubling of our engineering team in the next 12 to 18 months.
So let's just take a step back here and talk about why this is painful right now for investors, because there's no way we can know the real number, but what percentage of shares owned in the stock market do you think, Brian, just random guess, are held by people who don't intend to hold for more than 5 years?
What aren't owned or are owned?
Are owned by people who don't intend to hold for more than 5 years.
Oh, I don't know, 60%.
See, and I would guess it'd be even higher. Like I would guess it'd be maybe like 80%, but who cares? It's a big number. So when you see, when technology companies are in this, high growth technology companies are in this state where they're all of a sudden not as popular, whether that's because of inflation, which doesn't make a whole lot of sense, or geopolitical reasons, you got all of that. And then you combine it with the company saying, we're doing well, we're profitable, but we're focused on like 2026, 2027. That can be a tough pill to swallow if you're not truly a long-term investor. And I would argue most shares are held by people who aren't truly long-term. So what did the stock fall? Like 17%, 18%, 20%?
Something like that. But yeah, what is the share price at any given time? It's the marginal trading at that specific point in time, right?
Right.
It's the marginal demand. So the whatever, how many thousands of, it's the 500,000 shares that I've traded today is what's controlling the price. That's it.
Right.
So what happened on that day versus the price, that's what controlled it.
And so I'm just saying that this is what I love is this channel is for individual investors, and the biggest advantage we have is called time arbitrage, which basically just means my time frame is different than your time frame. Therefore, because I don't need this money for 3 years, and I'm willing to, I mean, it's not pleasant, but I'm willing to deal with what's happened since mid-November, then over the next 10 years, it can be hugely beneficial. I'm not seeing anything yet. I'm curious if you are, that makes me say, maybe come 2026, this isn't going to look so good. Are you seeing that?
Well, this is like exact same thing I just reviewed with GoodRx earlier today. It was like the stock price fell like 30% in response to the earnings. You just be like, oh my God, the business must be falling apart. And it was like they slightly underperformed on their quarterly results, and they slightly guided lower because of Omicron. But like the rest of their business was doing exactly what management said, but there was a 30% decline in the stock that day. So it's like, watch the business, not the stock. It's so easy to say that. It's really hard to do that.
It's so hard to do it. We shouldn't overlook that too. It's really hard to do when it's not going well.
But look at, PubMatic, they came public in December of 2020. Okay. I don't know what the number was, but the first trading is 29. The stock got up to 67 within a few months, and it's been a sickening slide. But if you just look at their financial results, what did we just say that looks bad in any way? 50% growth, record profitability. They're making investments. They're taking market share. Like, so far, everything's sunshine and roses.
And also,
why investing is so maddening to so many people, because you're like, this doesn't make sense.
Right. And now, to be fair, we benefit from things that don't make sense too. Like, there are times where stocks go up and it's just like, well, this doesn't make sense.
Exactly.
But you got to take it.
2020 didn't make sense on the way up.
Yeah, exactly.
Yeah. Just like 2021 and 2022 hasn't made sense on the way down as much sense. Oh, there are some macro stuff that's certainly playing on. But anyway, let's go.
Yep.
So almost double market growth. So they picked up market share. Revenue was this. Okay, we saw all this. Anything really stick out
actually,
here?
What did that say? Excluding political ad spend, it was still up 40%. All right.
Yeah. So Trade Desk noted the same thing. So a year ago period, there's lots of political ad spending. So the year-over-year growth might not seem as impressive, but if you exclude for the political spending, which is one-timey, the growth would have been even higher. So it's kind of like adjusted growth. But political ad spending is going to come every
2 to 4 years.
2 to 4 years, right?
Unless those school board elections really start picking up across the country.
So let's say EMEA, Europe, Middle East, and Africa in particular grew strongly with 55% year-over-year growth. We trailed by America at 63. So the Americas are only 63% of revenue. EMEA is 28%, and Asia Pacific is at 9%. So this is a global business. Good to see. We have 20 industry verticals. Omicron in December dampened ad spending related to in-person activities.
Well, that makes sense.
And shopping grew 78%. So our growth would have been even stronger. Minimal impact from Apple's move. Now, one thing I did want to call out after we're done with this is that this might have been somewhat related to so all the numbers
149%.
Really
That's crazy.
Really good. I will say on the Trade Desk's call, they did say that they were rolling out a new service that allows customers to essentially tap into the supply side of advertising agency, and they called out that they're not trying to displace their partners, PubMatic and Magnite. But that is a technology that they are offering to their customers. So that could be an extra reason for, I guess, PubMatic users to be a little bit skittish about that. But just because they're doing that doesn't mean that translate into thesis busted.
I'm not trying to replace you, but here's a product I'm offering that could replace you.
Well, we'll have to see if that impacts their results, right?
Right.
Lots of impressions. Cost per impression went down. To give you a sense of the magnitude, if our cost reduction had been 25%, our cost of revenue would have been $25 million higher. So they're really achieving this high gross margin through scale. And if they're going to keep investing in that and they're going to keep growing their revenue, their gross margin could keep going up.
It really could.
That would be really, really cool to see. Mission-driven company, excluding stock-based compensation. Yeah, so these are just the numbers for the quarter that we kind of looked at. Adjusted earnings were slightly higher. $160 million in cash, no debt, 25% revenue growth for the year. So I'm just going to say it was I don't see anything in here that would cause any sort of concern at all, but they're doing what they need to do. My bottom take line is just like we just saw early today with GoodRx. GoodRx missed its results or reported weak. These were strong. So I don't see why the stock would sell off other than just broad-based, shoot first, ask questions later, and maybe the forward guidance wasn't as rosy as management was expecting. But what's the takeaway for all these recordings reports? One is thesis on track. Mm-hmm. Yep.
Yes.
There you go.
Definitely. I mean, to me, all right. So here's the interesting thing is, to me, when we discussed this, we talked about how there's some network effects because they're gathering data little, but the switching costs are the big thing, and 149% dollar-based net retention. That tells me that there's some switching costs involved here. And the thing is, the bigger it gets, the more I believe that there could be actually more network effects because they're gathering more data. But there's also this low-cost production that, to me, if I went back, I'd have to go see and remind myself what score I gave them for low-cost production. But the fact that they have lowered the cost of delivering these by 50% internally, because they own their servers and they own all the infrastructure and they own everything, which is something I'm almost positive Magnite, for instance, doesn't do. I would maybe bump that up a little bit. And I would say, oh, this is actually quite strong. I'm curious, can we look at their free cash flow for the year? And then I'm also just curious to go to Glassdoor and see what kind of growing pains might be popping up.
So this is the full year results. I don't know if they have.
There we go.
Okay. So net income was $56 million for 2021. If you want to use capitalized software, $9 million. And then property, plant, and equipment was $30 million. So if you add those together, $40 million from that,
$50 million.
$50 million in free cash flow, despite investing pretty decently in themselves.
And it was -$7 million the previous year, if you include that capitalized software cost.
Yeah, where did that go? Yeah, so last year it was negative. So last year it was negative. This year it was solidly positive. And just to throw some metrics around valuation, so the company did $226 million in revenue. The current market cap is $1 billion. So they're trading at 6 times sales on a gross profit basis, $168 million. And so they're trading at about 7-8 times gross profit, and on an earnings basis, one more.
So $1. So it's 25
times earnings. That's close to a market multiple, like a little bit less than a market multiple. But
if you divide that market cap by 50, it's trading for 25 times free cash flow.
25 times?
Yeah, because 50 million. And it's 1.25.
Yeah, million. A little bit higher than that, but their net income is higher than their free cash flow because of their investments in their business. So, sure. Throwing it out there, but those numbers are basically suggesting we don't think this is going to happen. So, yeah.
I mean, Brian, do you remember the trading rules? Like, if we talk about PubMatic on YouTube, do I need to? I don't know.
Yes. We can't buy this stock for
all right, fine.
A couple days.
So in a couple days, I'm going to be buying this stock. Right now, it is 1%. It is 1%, maybe a little bit less of my portfolio, and it's going to be more. Like, oh, and Glassdoor. Can we check that real quick?
Oh, yes.
Too?
Sorry. Glassdoor, PubMatic. Let's see, 4.3 out of 5 based on 392 reviews.
All right.
It looks pretty good.
We're not seeing a huge dip here.
Slight dip, but still well over 4.5. And the big one there is work-life balance. Senior management ranks higher than work-life balance. That's rare. Usually senior management is the worst reviewed thing.
Dino has a nice question. He says, are there any concentration risks that we should know about? If I remember, Verizon was one at the last annual report.
Well, we can check the they just published the 10K.
Oh, really? Look at that.
Yes. So I'll show you how I'm doing this. So the question was about concentration. So I'm going to go to the SEC filings, and they just published a 10K, which is the annual report. So if we open that up and we do a concentration search, concentration of ownership, concentration of credit risk. I don't see anything there. Revenue. There we go. Okay. So for the year ending, one publisher represented 17%. For the years ending, it was 17% of revenue. Two buyers were 29% of accounts receivable. So there you go. So two buyers. There's accounts receivable concentration, and based on revenue recognized from individual publishers. So there was 17% revenue from one publisher.
And I think that's Verizon Media.
And then accounts receivable. Yeah, I think they called that out before.
But it's falling quite a bit.
It's falling. Yeah, notice how much that's falling. So that's what you want to see. If that keeps up in 2 more years, they won't have anything to worry about there. And they seem to be credit worthy. So thank you for the great question. Now, there's a good question here from
Samuel.
Kevin saying, given that they're only a $1 billion company, are you worried that they're focused on profits when they should be focused on growth? I would say they're doing a really good job balancing both.
I agree. I think. Go ahead.
I personally wish more companies would follow this kind of. Had the ability to follow more of this kind of model.
Well, right. Part of the problem is just that they can't.
Yes. So,
well, how about Samuel's question? I think that one might be worth us just to get an idea. So we said 25 times earnings, somewhere between 20 and 30 times free cash flow. Like what is?
So the trade desk is going to be way more valued. So the trade desk is 35 times sales. These guys are 6. Magnite, I don't know. Let's check out Magnite. Magnite is 4 times sales, and is that 16 times earnings? Yeah. So even Magnite's even cheaper on a net income / sales basis. Why?
Yeah. What's Magnite's free cash flow?
I don't know. I've never done a deep dive on Magnite. We certainly can if there's interest in this. $100 million in free cash flow.
All right. So let's just take 1 second. And if my memory serves, and it might not serve, and if that's the case, then throw this out the window. This won't age very well. But if memory serves, Magnite doesn't own their own infrastructure the same way that PubMatic does. That means that Magnite is getting the profits now, but there won't be any benefit in the future.
Depends. I thought the same thing about some other companies like Snap and Pinterest. They were all dependent on AWS, and their gross margin increased over time. So that might be something. With Magnite, the thing that bothered me about Magnite, it was like an amalgamation of several different companies that came together. It's not like it was one company founded organically from the way up. I think it changed its name like twice since coming public. So that always... growth by acquisition has always bothered me. It's one reason I've never invested in Teladoc either. But anyway, if there's interest in us doing a deep dive into Magnite, I'm happy to do that.
Yeah.
But overall,
these are good questions.
Right now, based on what I know, would I rather bet on PubMatic or Magnite? PubMatic.
Yeah, me too.
That's what it is for me.
We did this before. What's your flag? Because mine is
green.
Mine's not even green. Mine is checkered. Mine's like go buy.
Yeah,
just go do it.
Yep. So yeah, I didn't do that with GoodRx. GoodRx, I would say green with maybe a couple of specks of yellow on it. This I would say green all the way. So yeah, I'm happy to have Magnite on the thumbs up part of my portfolio, and it's in your portfolio, and I understand why. I understand why. All right. Well, we hope that you found this to be useful. We will be back next week to returning our more normalized schedule now that Brian is back in action. We hope you found this useful. If there's any stocks you want us to review the earnings of, please let us know in the comment section below. Brian's
Woo!
out.